My guest is Adam Hamilton, CEO of ZealLLC.com. He's speaking to us from Colorado. Welcome back to the show, Adam.
Hey, Jim. Thanks so much for having me.
The price of oil has still stayed just above $50, but it has come down slightly. Is it likely to come down even more?
I'm still on the bearish side in oil, Jim. I know it's kind of a minority right now. There's a lot of exuberance in oil. There's a lot of production in the U.S., a lot of shale oil coming back online. You see those numbers every week in the Baker Hughes rig count. Drilling activity is going up in the U.S. There's a lot of drilled but uncompleted wells that need to be fracked that are going to come online pretty quick as oil's up here and it's profitable, especially in the Permian. Bakken's kind of not doing well up in North Dakota in the low 50s. But I think there's a lot of U.S. production still going to come online this year. And I'm also concerned about OPEC. OPEC amazingly has complied pretty closely with their quotas for this new production cut that just went into effect this year. And that's shocking because we look at the whole history of OPEC compliance with their stated output goals since like 1986. It's really low, like 60, 70% compliance over that whole time. And I've seen numbers like 96% compliance this time, which is just shocking. And one thing I found that's pretty interesting is the Saudi Arabians want to do an initial public offering with their national oil company, Saudi Aramco. And I think that's supposed to come in the next year or so. They want to raise about $100 billion, which I think would be the largest IPO in market history. And that would value Saudi Aramco at like, $1.5 trillion, somewhere in there. I've heard $1 trillion, I've heard $2 trillion, somewhere in that range, depending on what kind of price they can float it at. They need that money to plug gaping holes in their budget because of low oil prices. And so apparently the Saudis are producing below their OPEC quota. Like they're going above and beyond what the OPEC quota is. And the oil guys think this is because the Saudis want to make Saudi Aramco look better. The numbers this year look better for the Saudi Aramco IPO whenever it happens. And so I think the oil price is kind of artificially inflated by the Saudis doing that. And once that giant oil company IPOs, they have no incentive to do that. And they can let the oil price do whatever it wants again and punish all the cheaters in OPEC, and there's tons of them as usual. So I'm kind of bearish on oil. Oh, one more thing with oil, Jim. Oil has a high correlation with the stock markets, the U.S. S&P 500. When the stock markets rise, people tend to get exuberant about oil, and they think that if the stock markets are up, the world economy is doing well, therefore oil demand is going to be higher as people buy more gasoline, travel more. And they think that when the stock markets sell off, the world economy is going to slow down, and therefore gasoline demand is going to fall, and that hurts oil prices. So when the U.S. stock markets roll over, which they're so overdue for here, I think oil gets sucked into that sell-off. Almost every major stock sell-off in the last decade, 15 years, the stock market sucked in oil with them just because of that sentiment link between those two things. So I'm relatively bearish in oil, although I don't like to be.
What price do you think it's going to hit?
Oh, man, I have no idea. I don't think it's going to get back to year-ago lows, which, around $25 or so, but wouldn't surprise me to see $40 again, U.S., for a barrel of oil. But most of my work's in gold, so I don't have tons of oil models I've done. My research is pretty shallow on the oil front, unfortunately.
What happens when all of these shale oil and frackers really gear up, especially in the summertime when they seem to hit the peak production?
I think the oil's going to come on really fast. It doesn't take long to frack a well relative to a couple weeks. And once that well is fracked, they have huge production initially. The fracked wells, especially in the Bakken up in North Dakota, where I grew up, they have the production just spikes hugely after they frack a well, but then it drops almost exponentially after that. So if it takes a couple weeks to frack a well and maybe a month to get a crew out there now, within 4 to 6 weeks after someone makes the decision to complete a well, oil could be flowing fast. And if you multiply that across hundreds of wells across the U.S., you can really get a big surge in oil production. I've read that the Bakken's declining as well. Like if you look at the total production numbers out of the North Dakota shale oil fields, they're falling despite the well count being relatively constant. And these wells are depleting faster than people expected. And so there's also that which is bullish for oil. Maybe they'll go ahead and frack these drilled but uncompleted wells, but then oil production won't rise enough to offset just the natural depletion of the other wells. And so there's conflicting things coming out of the Bakken. But in general, I think that once these wells get fracked in Texas and North Dakota, that U.S. production is going to rise. That'll contribute to just the huge glut of U.S. oil and gasoline inventories, and that should push down global oil prices.
Now, of course, we always look at OPEC, a group. How much or how does OPEC work, and how successful have they been with their production freeze?
Well, this one's been really successful, apparently. It's kind of a sham in some ways. Like when they were back in December, when they were negotiating this latest production cut, they were producing at their highest level ever, or near their highest level ever, and so they cut production at record levels essentially, and they allowed wiggle room for like Iran, who wanted to produce more oil, after the sanctions got lifted. And so these production cuts come from super high levels already, and they're really minor cuts. Like if you look at them compared to year ago levels, they're not that substantial. They're really not substantial off the record levels either. So I think it's more psychological than actual supply and demand stuff. The stock markets are high. Everybody thinks that the world economy is doing great, and therefore oil traders are willing to bid up oil. I can't say about this week, Jim, but I've read in recent weeks how oil futures long positions have been at like crazy all-time record highs from speculators. There's way, way, way too much bullish sentiment in oil. Whenever that happens in any market, there's usually a hard reversal soon afterwards, as those long speculation positions have to get unwound, usually pretty rapidly, since selling begets selling, and they're highly leveraged. So, yeah, it seems pretty bearish to me overall.
We'll have more with Adam Hamilton right after this.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Adam Hamilton. Adam, the Dow set record highs a number of times the last few weeks. Now we're seeing the U.S. equity markets come down, but not very much. Is this kind of the top of the market, and is it going to be a slow rollover, or will it just plunge quickly?
Oh, man, that's a great question. I've been bearish in these stock markets since 2013, unfortunately. That's when the Federal Reserve started its third quantitative easing campaign that was open-ended. Whenever the stock market started to sell off, the Fed officials would just say, hey, well, we can print more money and buy more bonds, so the stock sell-offs will be truncated. So I've been waiting for this thing to top since 2013. That's probably when the natural bull since 2009 would have ended without extreme central bank intervention. And so I've been bearish in these stock markets for a long time. So every day since the election, I just watch with increasing incredulity, seeing these stock markets go higher and higher, crazier and crazier. The earnings aren't there. Since the election, S&P 500 earnings expectations for 2017 are actually dead flat, Jim. Like the stock markets are up 10, 12%, but the earnings expectations haven't risen at all, even with the expectations for tax cuts and infrastructure spending and less regulation. So these stock markets are way out over their skis here, which is really scary. I don't know. It's hard to see them falling sharply despite them being so overvalued. They're trading around 28 times earnings, S&P 500 in the U.S. That's technically bubble territory historically, twice fair value of 14 times. But major bulls, this bull is 8 years old now, almost exactly to the day, actually exactly to the day, and they generally tend to roll over gradually, these bull toppings. You generally have to get 6 months or 8 months into a new bear before you start seeing the sharp bear market down legs. That's when people start to realize, hey, this bull might not be alive anymore. And so I would tend to see a more rounded topping rather than a sharp sell-off.
One of the things the Wall Street Journal had in a headline was the public is now getting back into the market. What does that mean, and is that a warning sign?
Oh, absolutely. It's hugely bearish. This trading is all about greed and fear. You got to manage your own emotions, your own sentiment, and then you have to fight the herd emotions. When everybody's excited about something, it's too high. You don't want to buy. The gains already happened. Yet that's when people want to invest. They want to invest when things are hot, when things are exciting, when things are high. A week ago today, March 1st, the S&P 500 shot up 1.4% to 2396, an all-time high. The morning after Trump's speech before a joint session of U.S. Congress, where he had absolutely zero policy detail. He sounded presidential, and he was somewhat conciliatory, I guess. Traders said that. And the next day, March 1st, it was the first day of the month, and that's when pension capital flows into markets. Like people send money for their retirement accounts, and that's when your custodian ships it to the markets for money managers to buy. But anyway, in addition to those pension fund inflows, there was something like $8.2 billion of inflows into the leading S&P 500 exchange-traded fund, which trades under the symbol SPY, SPY in the U.S. And that was the biggest since, I think, December 2014, second biggest daily inflow in 6 years. And those big daily inflows are often show public participation. You know, normal investors trying to get into markets and they're topping. They're really dangerous. Another interesting thing, last Thursday there was an IPO of the parent company, or that Snap IPO. The company did that Snapchat phone app, and that was just ludicrous. Like, this company has never made any money ever. It earned like $404 million in revenues last year from advertising. Yet it was trading at 71 times sales, 71 times revenues that day the IPO closed. The next day, Friday, it was up to 78 times sales. And people buying this Thursday and Friday were new investors. They were millennial retail investors. A lot of them hadn't been in the stock markets before. There's just great euphoria out here. And I think when ordinary people who don't study the markets, don't follow the markets, get really excited about buying, when you hear about how awesome these markets are from random people who aren't interested in the markets generally, or the mainstream media, it's a really dangerous topping sign. I'm really concerned about the euphoria in the markets right now. One thing about euphoria, one thing I found is that people often mistake mania and euphoria. Euphoria is just a feeling of general well-being, that everything's great, everything's awesome, there's nothing to worry about, and that describes today's stock markets to a T. A mania is when stock markets rocket higher, like just go vertical, parabolic. We're obviously not in a mania, but there's definitely widespread euphoria, and it's extremely dangerous for stocks.
We'll have more with Adam Hamilton after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Adam Hamilton, CEO of ZealLLC.com. Adam, the price of gold keeps slipping a little bit lower and lower every week. Will it stop around $1,200, or is that kind of the breaking point?
You know, gold's been pretty interesting. We talked about the stock market euphoria, and that's the worst thing possible for gold. Gold's an alternative investment. It tends to move counter to stock markets, which is kind of extremely rare. And so when stock markets are at record highs, when euphoria reigns, people don't see any need to diversify their portfolios with counter-moving gold. Gold's kind of the anti-stock trade. So the extreme stock euphoria we saw over this past week really hit gold. A week ago on Monday, the last Monday in February, gold actually hit $1,264 intraday in the U.S., which is pretty awesome. And then something really interesting happened. The Federal Reserve has a meeting coming up on March 15th, and last Monday morning, February 27th, the rate hike odds implied by the futures markets, federal funds futures traders, are sitting at 22%. And the Fed can't even think about hiking rates unless the rate hike odds get above 70%. Because if they surprise the markets, especially when stock markets are high, they could ignite a big sell-off and, you know, just ignite a political firestorm, be attacked. And so they won't surprise the markets ever with rate hikes. But that day, Fed officials started speaking, and for some reason, right when gold hit 1264, the rate hike odds surged 11% that day, from 22% to 33%. And every day since, they've kept surging. This morning, or yesterday afternoon, they were at 84%. Monday, they were at 86%. And so they've quadrupled in essentially 4 or 5 trading days, which is unprecedented as far as I can tell. I don't have a complete federal funds rate, futures implied rate hike odds data set, but I've never seen anything like this in my data, and I've never heard of anything like this from people who've been following it longer than I have. And so gold's just been hammered on this coming rate hike. Now it's almost a certainty at 86% odds for March 15th. It's frustrating because future speculators always fear Fed rate hikes, yet there's no reason to. Historically, gold does really well in Fed rate hike cycles. There's been 11 since 1971 before this current one. Gold's average gain through there was like 30% through the exact span, beginning and end of the rate hike cycle. The last rate hike cycle was from June 2004 to June 2006. Gold went up about 50% over that span. There were 17 rate hikes totaling 425 basis points. Gold does really well in rate hike cycles if it enters them low and if they're pretty gradual. This is obviously the most gradual rate hike cycle ever. So far, one rate hike per year, December 2015, December 2016. And gold hit a 6.1-year secular low the day after the first rate hike in December 2015. And so anyway, back to your question about gold. I think gold has sold off in the past week because future speculators are worried about the Fed rate hike. They shouldn't be, but they are. One thing we talked about last month, Jim, is future speculators really weren't involved in this gold rally, this new gold up leg, since mid-December 2016. Like they hadn't done any buying at all yet. Well, the week right before the final week of February, they did huge buying, just a massive buy. They finally started to buy into this psychologically, so they started to put capital into gold to buy this up leg. And that was right when those Fed rate hike odds started to soar in an unprecedented fashion. And so I think the future speculators have unwound most of the 30K or so long contracts they bought in the preceding week. And so I suspect the selling is almost over. Future speculators probably don't have many longs left beyond normal levels. And we have Jobs Friday coming up this week. If that's weaker than expected, that'll drive some gold buying. In both December 2015 and December 2016, gold bottomed the very next day after the Fed rate hikes. So future speculators fear these things. Then when the Fed hikes rates, they see that gold doesn't implode or, just colossally plunge, and they're like, okay, we can buy again. Those rate hike odds that future speculators are trading on, also they plummet for the next meeting after a rate hike. So for the coming meetings in like May and June or whenever they are, the rate hike odds will just plunge dramatically after the mid-March rate hike if it really happens. And so I think gold's probably going to bottom here around its 50-day moving average. That's like at around 1208, 1210 today. I don't see it going below 1200, although it's certainly possible if sentiment gets carried away. So
I know a lot of people think gold, of course, long-term is going to go up, but it really does depend on what's happening on the stock market, doesn't it?
Stock market's the biggest influencing factor of gold by far in recent years. If you overlay a chart of gold and the S&P 500, the inverse correlation is huge. If you look at one of the main drivers of gold, which is stock market capital flowing into the leading GLD gold ETF, the American Gold Exchange Traded Fund, which dominates world gold ETFs, those capital inflows, they grow dramatically when the stock markets sell off, and that's when people want to buy gold to diversify their portfolios. And they fall dramatically when the stock markets rally, and that leads gold to slump. And so stock markets are everything for gold. It's really frustrating because these stock markets are so fake and euphoric and just wrong in so many levels. Stock markets are cyclical. They rise and fall. The bulls are followed by bears. It's a perpetual endless cycle. We're 8 years in this bull market. It's up 254% S&P 500 terms, and it's way too big, way too long, way too overvalued, way too euphoric, and we need another cycle here to push stock valuations lower, a bear market. And once that happens, gold investment demand will explode, but as long as the stock euphoria remains, it's a huge, huge downer for gold investment demand. It really retards interest in gold, unfortunately.
What about mining stocks? What's the better bet right now, bullion or stocks?
Mining stocks, without a doubt. We've talked about gold selling off in the past week. The mining stocks have just been crushed, Jim. It's been really frustrating. Yesterday, gold stocks were trading at their lowest levels of 2017. Like they exited 2016, the HUI, the major American gold stock index, when gold was at 1150, was actually higher than it was yesterday when gold was at 1215. And so gold stocks are radically oversold right now. People newer into gold stocks tend to run tight stop losses. I'm all for stop losses. I run them in all my trades, recommend them to our subscribers. But gold stocks are such a volatile sector, you really have to run loose stop losses. I run massive 25% trailing stops. And that's because, 20% drawdown in gold stocks isn't uncommon at all. So people set 10% stops, which would be crazy wide in a normal sector. They can get stopped out really easily, and these stop losses cascade. You have positions, they get stopped, and that causes my positions to get stopped as the selling accelerates. And so we've had really extreme gold stock selling over the past week or so, on a relatively minor drop in gold, really. And so gold stocks are a much better bet right now. They're really oversold relative to gold. And once gold turns around and starts marching higher, probably soon. Actually, there's a major seasonal low for gold and gold stocks in mid-March. We're coming up in that in the next week or so. And then there's a strong spring rally from mid-March to late May, early June. And so I think gold stocks are going to radically outperform gold, primarily because they were sold so hard in the past week or so.
Adam, Thank you so much for all of your help this week.
Thanks for your time, Jim. Nice chatting with you.
My guest has been Adam Hamilton, CEO of ZealLLC.com. He was speaking to us from Colorado. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.